Hey, what is going on, everybody? TG here, back with another video. Guys, today we're going to be talking everything about calls, covered calls, poor man's covered calls, and call credit spreads, and how you can use that to consistently make money every week in the stock market. And the great news about it, for a lot of these, you only need about $100. While I do prefer accounts of about 2,500 or more, I really recommend the strategy for smaller accounts when it comes to call credit spreads and poor man's covered calls. Okay, actual covered calls, you're going to need a little bit more because you need 100 shares in order to write these covered calls. But you can still make some consistent income even with smaller accounts. Before we start this video, hit that like and subscribe button. And our Discord is in the link in the description below. Completely free. Join it. We do giveaways and signals for different trades throughout the week. We'd love to have you. Let's start this video. So let's go ahead and start with covered calls and what covered calls mean and how you can use that. So a covered call is essentially you own 100 shares of a stock. So let's use Apple, for instance. You own 100 shares of Apple. It's going to cost you about $13,363. Now, that's obviously a lot of money, right? But with that money, you can make money. If you have 100 shares of Apple, you are allowed to sell covered calls. You do this by going to the option chain here, hitting sell call, and picking a strike price that you want. Now, it's currently Thursday, and options expire on Friday, so you're going to get a lot less on the day before expiration. But if you go about a week out, which I usually recommend about 1 week out or 2 weeks out, something like that, you can pick a strike price. So let's say you want Apple to go up, but you also want to get paid for it as well. You can pick a strike price like 135 or 136. Let's do 136 because it gives us extra room. Essentially what this is saying is if Apple goes above $136, you would sell them those 100 shares at $136. But here's the catch. You would get paid $256 up front. So your break-even price for this trade would be $138.56. So let's go over a couple scenarios. Let's say Apple stays exactly where it is. Stays at $133, $134. You still keep all this premium, all the $256 you received, and you hold your shares. Now, another scenario. Apple goes above 136. It goes to like 138. Okay. Well, you sell those shares at 136. So any profits from $136.01 and above, that goes to them. All the other ones you get. So you would still get the profits, the appreciation from $134 to $136. So that'd be $200 profit right there, plus the $256 you received for selling that covered call. So you would make in total $456. Let's just round down in this case. So that's a pretty simple scenario, right? Now, every time you write a covered call, you're getting that premium no matter what. Whether the stock goes up, down, sideways, you're getting that premium. So you're making a consistent income every single week. So you make $256 a week. You could do that every single week for 52 weeks. You make a pretty good amount of money every year. Also, there's going to be times though where you lose the shares. So there's going to be times where Apple goes from 134 to 137 and you have to sell that. Well, you miss out on whatever the difference is between those two. So if it goes to 137 and you lost at 136, you would lose out on $100 of appreciation, but you would still make $256. So as long as it stays under $138.56, you have made profit on that particular transaction. So it's a very safe strategy. It's honestly basically the cheat code of trading, in my opinion. I think everyone should take advantage of this. If you have the capital to do 100 shares, I think you should take advantage of this. You see a stock on an up day, you take advantage of that. And then on that up day, you sell that covered call. All right, so that's one scenario. Let's talk about the poor man's covered call now. Now, I'm currently running the poor man's covered call on Amazon because Amazon obviously costs a lot to buy 100 shares of Amazon. So if we go ahead and look at my poor man's covered call on Amazon, we would scroll all the way down here, all the way down. See, I have a lot of options, so it makes it a little bit difficult. So right here, here's my poor man's covered call. I have one deep in the money call, as you can see, a 3,100 call, and it's sitting at 3,300 right now. Now, I can sell a call now because that in the money call acts as 100 shares. So since it's in the money, I can technically exercise that call right here, exercise that option, turn it into 100 shares, and if I lost it, I would have to give them those shares. So let's see what I'm doing currently with Amazon. So if we go to Amazon right now, I sold a call on it for a 33.20 strike price. Now, I am currently down a lot on this call, as you can clearly see, down 3,500 because Amazon absolutely mooned after I did this. That is the risk of the poor man's covered call. In this scenario, what would happen basically is I have to make a decision. Do I want to exercise my deep in the money call, or do I want to, yeah, see, Amazon's absolutely flying right now. Do I want to exercise my deep in the money call and lose my leaps call, or I can buy this back for a $4,200 loss and hold my other call and let that ride because I'm making money on the other call. Okay, that's the thing people don't realize. You're still making money because my in the money call that I have is obviously appreciating. It's going up in value, and it's going up a lot. Like I'm up 11,000 now on that call, but I'm still down pretty big on that covered call. So that's the problem with it. That's where the risk comes in. Is you can lose money on particular options depending on how you play it, but overall you're going to make money, and that's the beautiful thing about it. So right now, yes, I'm down almost $5,000 on that call, but I'm up 11,000 on the other one. So it acts kind of as a hedge, and I think hedging is very smart. It's a very good thing to do to hedge your call. So that right there is a poor man's covered call. You're getting an in the money leaps call, like at least 6 months out, and you're using that as leverage to then sell covered calls. So essentially you're able to make consistent income with that in the money leaps call, and you can hedge yourself by making money every week. Unfortunately, this backfired for us, and that's going to happen sometimes. But it's a good problem to have because it means that your leaps call is gaining a lot in value. So they're trade-offs, and currently we're going to wait this out because we have a 129 expiration, and it's 121 right now. So I'm assuming Amazon might pull back a little bit, but that thing has been on absolute tear, of course, right after I write it. But that's just the luck of the market, and oh well. Let's talk about call credit spreads now because that's another thing I do. Call credit spreads are essentially a bearish position. So those last two that we did, those are bullish positions. This one is a bearish position, and I want to show you a prime example of what I'm doing right now with that bearish position. So Netflix went up big yesterday, and I figured that it was a little overvalued in my opinion. I figured that Netflix was overbought. So what I did is I took a bearish position. I essentially went here and I sold a call. Okay, not a naked call because that is extremely risky. I sold a call credit spread. So what I do is if you think an underlying asset, i.e. Netflix, is not going to go above a certain price by a certain date, you can profit from that. So if I think that Netflix by January 29th is not going to go above $600, I can sell this first call right here and then buy the second call. Okay, let me see that. Let's move me out of the way a little bit. So I sell that first one, buy the second one. I get a total credit of $48. Okay. Now, the bid and the ask are going to be a lot different on these ones because they're two separate options. And that's where things can get a little bit tricky. There's two separate options involved. So you have to find the middle between the two. And so sometimes getting a fill is a lot more difficult for these. But if you put in, this and you put in the middle of it, I'm just going to put in 0.5 because I don't want this to fill. We go review order. And we would get $50 to risk. I believe this would be $250 because if you look at the difference between the strikes, that's how much you're risking in total. So if it's $595, yeah, $250. Now, if you think that it's not going to go above that, then this is a great trade because you're making a very, very good percent return on investment on this. I'm making $50 to risk $250. And as long as Netflix doesn't go above $600 by that particular date, I make all $50 and my collateral is released back to me and I don't lose anything. So the current position I'm doing on Netflix right now is a little bit similar to that, except it's a little longer out. All right. So if we go back to that same thing that we were just looking at, we go down to Netflix right here. It's a 650 call. And we're essentially saying that by March 19th, Netflix is not going to be above $650. As long as it's under that, we keep all $300. We are risking $2,000, but we're making $3,000. So we're making a 15% return on investment to say that the stock is not going to go up another big amount, basically. Saying that it's not going to go, up another 65 points. So it's something to think about that you guys can do to make consistent money every week. You can do this in any particular one, and you can risk as little as like $100 on some of these trades. If you go to like the SPY index and do that, you can make some very, very good money. Now, this is a strategy, like I said, I've been using for a while, and it's been paying off very, very well. If we look in the past couple months how we're doing, we're up $16.8 thousand using this strategy. So, like I said, I really recommend it to you guys. I think it's a great strategy, and it's a great way that you guys can make some consistent income every single week. I want to hear your thoughts about this. I want to know what you guys think if you guys are using the strategy yourself. But overall, guys, have a great day. Hit that like and subscribe button, and I'll talk to you guys in the next video. Take it easy, guys. Bye.